What's up guys, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending and investing. And today we're going to do that by talking about investing mistakes. Now, 2020 has been a crazy year so far and we're in the home stretch. With about 2 more months plus to go, there's still one more major thing around the corner, and that's the US presidential elections. Each time something comes to the front, especially in the news, it's going to cause a lot of uncertainty and a lot of really wild swings. Look, these feelings are perfectly normal because we're human after all, right? So the question really isn't about feelings itself, but ensuring that those feelings don't hijack us and then cause us to do actions that we might regret later. So that's why in today's video, I'll be covering some of the mistakes that we tend to make during times of great uncertainty, like this year, which can cause a lot of anxiety or excitement. And of course, I'll end off this video with a few good practices that we should be thinking about instead. So if you're ready, let's go! So tell me if this has happened to you before. You click on a derpy dog video and then next thing you know, it's 5 hours later. You wake up from the haze and then you realize that, hey, I really want a dog. But seriously though, that's one of the early signs of a mistake for us as investors. What happens there is that social media algorithms are serving us up the same type of information time and time again because that's what interests us, that's what's engaged us. So all this creates an effect called the echo chamber. And what happens there is that whatever feelings or beliefs that you might have had from before, they're just intensified, and on top of that, they're kind of rooting deeper and deeper in you. Now, it's all good if it's videos about silly cats, but it gets really dangerous for investors if you suddenly boarded a hype train that persuades you that the end of the world is coming, you should sell all your assets and go buy a bunker or maybe a tent and live in the woods. So after getting drawn down a rabbit hole, you end up with a second mistake. And this is when you start to deviate from whatever original investing plan that you might have had. Before the year, you might have read about, wow, having discipline and having a steady hand in case things happen. But then suddenly 2020 happened and then you got smacked in the face by the stock market crash. And then as a result of that, you start to change your plans. Now, some do it in very small ways, like maybe stopping their contributions to whatever investment plan that they had. Some take that to the next level, panic, sell all their assets, and then tell themselves, hey, I'm gonna wait this out. Unfortunately, there's plenty of research out there that shows that when investors do this, you are really reducing your kind of returns because you're trying to predict and time the market. Not only do you sell after you've taken a loss, but you're trying to look for that perfect time to get back in and therefore might miss out on some crucial days where the stock market rises again. Another version of this mistake, and one which I've made before, is to change your investing approach midway. When times are uncertain and they get hard and whatever strategy that you're using doesn't really work so well, it's very easy to start fearing that that's not the right strategy and then you bail. Now, change itself is not bad, but it's a mistake to do it when there's so much emotions going on, especially during these times of uncertainty. The third mistake is really the flip side of all those fear-based actions, which is greed. Think of this one as the evil twin of you deviating from your plan. So as a very realistic scenario, what could happen is that you've boarded some kind of hype train and then you feel invincible because it's a sure bet, I'm all in, I'm gonna make sure I'm gonna profit big from whatever move that's gonna happen. The ones that are playing with fire are those that are doing it with leverage, which is basically just borrowing money to try and make sure you maximize your profits. The ones that are playing with fire, covered in gasoline, are those that are doing all these things without having a proper exit strategy. Whether you're in Singapore or Malaysia, we don't really have a lot of deer walking around, but we do know the phrase, a deer in headlights. Because what happens is that you're frozen by fear, and then you don't take the necessary actions to minimize the losses you might be facing. And this kind of thing can truly wreck your account. If you really want some examples to look at, just go on Reddit and look for Wall Street bets. You might hear some stories of big wins, but be prepared to read about all those failures as well. What you definitely shouldn't fear is clicking on that like and subscribe button to support my channel and help me grow. The next set of mistakes are when things do go wrong for us. The first is us confusing a bad decision with a bad outcome. Wait, don't go. I'm not trying to play grammar games here with you. Let me explain. In the world of investing, sometimes we'll do everything right. We follow the playbook, we've made the right decisions, we've taken all the right actions. But unfortunately, life chance, gods, something doesn't work out and life doesn't reward us for it. So that bad outcome is not the same thing as a bad decision. And if you're being honest with yourself, you know exactly what I mean by making a bad decision. Because those are the moments when we've knowingly made a decision that is either off our plan or it's just based off impulse. Those kind of scenarios do happen every now and then. The really tricky part is that when you make a bad decision and then life rewards you for it. So imagine you made that decision, you got rewarded for it, and then you start patting yourself on the back because you're telling yourself that, hey, I'm a genius and things are going to work out exactly the same the next time. This can happen time and time, and we build our confidence, or rather overconfidence, in those kind of actions. And as a result, overconfidence can cause us to make bigger and bigger bets. And one day, it's actually very possible to make that one huge bet that goes wrong against you, which can actually wreck your entire investment account. Now, this isn't just theory. One of the investors that I truly respect, his name is Ray Dalio. Today, he's currently the head of the largest hedge fund in the world, but back in his early development days, he actually blew up his entire investment account thanks to overconfidence. Now, I've got a link in the description below so you can go read about that story. The final mistake I want to share is when we anchor ourselves in failure. As investors and as people, we can be really hard on ourselves. Where things go wrong is when we encounter those kind of failures or mistakes and we can't move on from it. We anchor ourselves in those mistakes or those feelings of failure by telling ourselves all kinds of really bad beliefs. You might say that, hey, I can never be an investor, investing is gambling, the stock market is only for professionals or only for pro gamblers, or even worse, you tell yourself that, hey, I'm a failure and I really don't deserve any success. In any investing journey, everybody makes mistakes. If some guy tells you that I've made no mistakes at all in my entire investment journey, tell the guy to get the hell out of here. So mistakes are normal, even some of the seemingly big ones. So it's not about shame or being completely immune to making any mistakes. It's about recognizing and being aware of our own behavior and feelings, trying to manage it so that we take consistently good actions and make consistently good decisions, and then hopefully start to build that confidence in ourselves over the long run. So let me move on to talk about the principles of investing that we should be focusing on instead. The first one is that if you're relatively new to investing, try and pay more attention to how the movement of the markets affects your emotions. If you realize that all these movement is causing you too much anxiety, it could actually be a really strong clue that you do not have the right asset allocation. Or simply translated, you might be taking too much risk in what it is you're doing right now with your investing. And this leads me to the second principle, which is having proper diversification. Now, if you find your portfolio overly concentrated with one or two big names like Apple, Tesla, or maybe even a cryptocurrency like Bitcoin, you might be needing more diversification in your portfolio. There's no one perfect formula for asset allocation, but do consider investing in different asset classes beyond the few things that you might have. The third principle is to remember that investing is really a long game. Now, I understand the feelings of urgency, the need to succeed now, and it's gonna cause us to want to make big bets to ensure that we get maximum profit in the shortest amount of time possible. Now, nobody can stop you from making some of those big bets. But at the end of the day, as long as you're completely aware that it's speculating and it's really not investing, then power to you and all the best. The next one is that if you find yourself constantly trying to change things up, or maybe your actions are a little bit more random than it should be, it might be time for you to create an investing plan. What it is simply a set of rules that you write down and you kind of stick to that hopefully keeps you grounded during times of great uncertainty or excitement. The last good principle is actually to minimize your contact with the markets or media connected to it. I get it, the stock market can be really exciting and it can be really entertaining as well. However, if you find yourself consuming that kind of media, feeling FOMO or getting triggered about doing something, maybe it's time for you to scale back contact with that kind of drug. So as the US election comes up in November 3rd, and the months after that, you can expect that there's going to be a lot of uncertainty and a lot of volatility in the markets. What about you? Do you have any tips to share about managing those kind of emotions or maybe minimizing mistakes? So if you enjoyed this video, maybe share it out to a friend that you think could find it useful as well. And if you did, I would really appreciate you hitting that like, subscribe, as well as that bell button, because all these things really help my channel grow. And I'm going to be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.